Everybody, welcome to this episode of Blood, Sweat, and Balance Sheets, a Flowcast special here. Super excited to be a guest moderator here and put Mike on the backseat and just being answering the questions for once instead of having to lead the charge.
As we scale up, I get to do less work and assign things out. That's my job at this point. So here we go, full display.
Yeah, full display. So super excited to be doing this episode. This episode today, we want to talk more about the IPO market, what's going on there, how to drive valuations, where companies should be at, and stuff like that. And so that's what we're going to kick off with. I'd like to first, obviously, introduce Mike Whitmire, our CEO and founder here, one of our co-founders here at Flowcast. And then I would also like to welcome Craig Clay, who is president over at DFIN, Donnelley Financial, who's a good partner of ours and has always given us a lot of great insight into the IPO field, what's going on here. And if you don't know DFIN, I'm a little bit blown, but it's just a fantastic competitor and leader in the capital market space and in the capital market technology space as well. So, Craig, if you would just give us a brief introduction about yourself and DFIN for the couple of people that might not have heard.
Sure. Great to be here. Thank you for inviting me. DFIN, Donnelley Financial Solutions, is a governance risk compliance company. We help clients on their road to readiness, whether that is for fundraising, an IPO, M&A, SPAC, DSPAC, and then certainly the compliance process that follows that with reporting to the SEC and other regulators.
And for reference, I've worked with Donnelley DFIN Solutions quite a bit from a knowledge base, from a thought leadership space, and they always just give us an immense amount of background and knowledge in the space. So if you ever need more information on this, we have a webinar that we just launched with them. We're having an ebook that's coming out soon. So if you want more information other than this podcast, please stay tuned with us. We have more for you. I think when we look at the IPO markets, everybody's been in big anticipation for 2024. 2024 has been a year that people are just chomping at the bit to say, is the market going to soften up? Are we going to have more IPOs coming? What's going on with SPAC, stuff like that. We've seen some good activity in the first quarter of the year. But I think people are still a little bit unsure of what they can really expect for IPOs in 2024. So to kind of set the stage for that, Craig, I was wondering if you could give us like a brief overview of what happened in 2023 and help us understand where we were so we can kind of understand where we're going to go.
Sure. 2023 was a little more optimistic than we've been in the last 2 years. The long-stalled pipeline for IPOs began to unclog as more companies went public and certainly made plans to go public. The total IPO market in 2023 was comprised of 123 deals. There were 59 international deals. There were 82 deals that raised less than 25 million. 72% of those deals of the 123 raised below 50 million. So the market was really characterized by really small international deals, more akin to fundraising. There were only 30 deals that raised over 100 million. This was an increase from 2022, which had 18, but it was significantly less than the 275 IPOs that raised over 100 million in 2021. So, a better year, but significantly off of the peak. Whether we get back to the 2021 levels ever, we'll see. There were 7 offerings in 23 that raised over $500 million. So some notable ones: Instacart, Nextracker, the ARM IPO, Birkenstocks, and Accelerant. So it was a okay year, better than 22, but still not so great. Maybe one other call out or highlight for 23, a continued bright spot in the IPO area was spin-outs. So Form 10 that's spinning out of a company. So investors have typically looked at these offerings a little more favorable in a difficult market. Is there typically more mature businesses with solid profits? So there were a number of spins that happened last year. Kellanova spun out from Kellogg. You had Sphere, which spun out from Madison Square Garden. So you had some really notable large companies that spun out from even larger companies, which is another form of IPO,
Mhm.
and I think set us up to be successful here in 24.
Yeah, those carve-outs are very interesting. I don't think people think about how many of those really happen in the space of, I think GE had quite a few back in the day when they were kind of like, moving away from being a conglomerate. But to your point, it's a more sophisticated entity. They have reporting that's already set up. They're very much already marching at that public order. So people have a lot more probably, faith in their ability to execute as a public company instead of transitioning from a private enterprise to a public enterprise.
Yeah, that one's interesting. Operationally, you're probably well suited to just slot right into being a public company, and it's about that executive team learning how to handle the street and whatnot. Craig, I'm curious for the sub 25 million fundraise. Is there an industry that's concentrated in?
Um, no, but certainly one of the main characteristic was they were international deals. So they were international companies that were tapping the U.S. market. Um, small small deals with not a lot of float.
Okay. Being in Southern California, I wonder if I'm in a bit of my kind of biotech bubble with San Diego being so hot. So to me, that seems like an area where there were a decent number of IPOs. But am I trapped in my bubble? And statistically, from your perspective, it really wasn't quite as many as my gut makes it feel like.
I think it probably felt better than it is, and most of those deals in San Diego are at the 100 million range. They're certainly above 50 million.
Yeah.
They're not these small sub 25 deals.
Makes sense. Yeah, they're funding intense R&D, which takes time and a lot of money with the scientists and whatnot. Makes sense.
Yeah.
Just
So
one thing on GE, we DFIN we're happy to support GE Healthcare, which did spin out of GE in 2023, so last year.
Okay, yeah, I remember seeing that in the news, and I think that's like a classic example of you have these massive corporations out there, enterprises that are global that are, due to public sentiment and investor sentiment, wanting to kind of tailor more of where their company is going. So they're stripping off pieces of it that maybe don't make sense strategically within where they're driving the company. And a great place to dump those is in a carve out or a spin off from the entity. So
Well, if you're a 30 Rock fan, you know it's all owned by the Scheinhart Wig Company at the end of the day. So they're the ones spinning it out, right?
You are.
great
DFIN,
throwback.
Donnelley Financial, spun out in 2016. So we are the product of a spin as well.
Yeah, you've experienced this firsthand. Can you tell us what it was like to do that? And by the way, shout out for doing such a great job with it. If anyone wants to fire up the defense stock price, you'll know how good of a job Craig's done doing this.
Yeah, it's there's a heavy lift, so you're a business unit, and then suddenly you're a public company. So there's a lot of transition service agreements that have to happen. You have to stand up a company that's fully functioning with what had been a lot of shared services. So whether that's IT, whether it's HR, legal, it's a big lift to do it in short order, which we did. We did it in about 10 months from announcement to trade.
And I'm curious with a little bit of the behind the scenes decision making. How were you selected as the one to lead that organization, and what were the conversations like as Donnelley made that decision?
Well, there are a lot of leaders. We have a great team that's leading the company, and it's evolved. I mean, 2016, a long time ago at this point. So some folks have moved on. We've hired great new talent as we pivoted in our transformation to be a software company, to really take the expertise that you talked about, the regulatory expertise, and couple that with great software to make our clients' jobs even better.
Awesome, very nice.
Yep, take some notes, Mike.
Will do.
Put that down in your CEO journal.
As we spin out Flowcast Studios as a public company. Yeah.
That's right. One day, big dream big. Well, I think that's some great perspective. And Mike, I'd actually like to get a little bit of your perspective on 2023. So when we look at, I think my anticipation when I looked at 2023 is I was expecting to see a lot more M&A activity than I necessarily saw in the marketplace. It was good to see the IPO market kind of loosen up, even though it didn't quite completely unclog as Craig was telling us. But give us some reaction as far as liquidity positions of companies in 2023 versus valuation goals in 2023, and maybe that how that played into the marketplace.
Yeah, that's a great question. And maybe we split it into a tale of two worlds. It's the some of the publicly traded companies that have been purchased, and on most of that you see with private equity coming in and buying at a good price. And that's really, when there's an opportunity, when the stock market has taken a downturn, private equity sees a good deal out there and a company that they can maybe clean up and turn cash flow positive and take public again in a couple of years. I think the vast majority of those deals are behind us, mostly because the stock market has rebounded a little bit within the tech world. And so it's gonna be tougher for PE to get those deals done. So I think we've seen the end or near the end of that type of dynamic. We might see one or two more. I won't be surprised, but I think that road's coming to an end. On the private company side, the companies like Flowcast or like others who raised a ton of money in 2021, we raised well more than enough needed to run to cash flow positive, and we're able to reduce burn and put ourselves in a position to do that. So a lot of entrepreneurs find themselves in a spot where we can just wait this out. And a lot of us didn't start our companies to sell at some point, and so certainly not going to sell when the market is down as well. You've taken on a ton of risk and you've done a lot of great work. Why sell now if you don't have to? So a lot of people just sitting on that balance sheet and waiting for things to open up again so they can spend more on the go-to-market side. Stefan, you've seen us doing that internally. That's how we've kind of adjusted to this market. But all that said, what's been going on behind the scenes is a lot of the earlier stage companies. So let's say they were maybe seed round or Series A round in 2021. They oftentimes were not able to adjust quickly enough because they have to burn to invest in product upfront. They have been, many of them have been bridged over the last couple of years by their investors, and just inside rounds get done that are not announced. So this is something I just recently learned about, because the venture capital community isn't proud to be like, yeah, my company's not doing well, so we just did an inside round. We had to make up a price. We did it flat or maybe a down round. Like, no one talks about that. But then you realize, you start to hear stories, and you have investors just trying to find landing spots for their companies at this point because they're running out of money. So I think we're actually at the point where those types of businesses are going to finally start to pick up some M&A traction in 2024. Like I said, because their balance sheet from the 2021 fundraise is running dry, and now the extensions from their VCs, the internal rounds, are starting to run out as well. And a lot of those VCs are just tapped at this point. They have no dry powder left to deploy. And a lot of VC funds are having a hard time raising another round of funding to keep those companies going. So I think we'll see a wave of M&A at the lower end of the company size range, as well as a lot of VC firms going out of business. A lot were founded in 2021. I can't imagine they're showing great returns. And so how in the world do you convince an LP to give you a second shot after the first one went so poorly?
Yeah, or you just couldn't find the right investment, so you opened up a fund and you couldn't align the investments in time for that fund anyway.
And it's tough because when you just started a firm, you don't have any differentiation in the market. You're not, hey, I'm Andreessen or I'm Insight or whatever. You have to do something different, which is generally really hustling to get deals and then paying up for them. And so if you're paying a better price for them, you know how that's going to work out on the downside.
And I think that's what a lot of people maybe don't understand, is that a lot of these VCs and PEs could actually afford to do. Back in 21 going into 22 and 23, they had enough of their funds that they could, that was on call, that they could call to do bridge rounds. And, eventually those funds dry up, or if they go to start a new fund, they couldn't necessarily invest in existing portfolios anyway. And so there's a lot of that goes behind the scenes when it comes to the private equity VC space that kind of, I think, bridge people in 2023, but not necessarily into 2024.
It's even more than that. Sorry to keep going on this, because I find this is an interesting dynamic as well. Myself as the accountant, we sign contracts, we follow rules, all that kind of stuff. I assume that, hey, if I have dry powder left from a fund that I raised a couple of years ago, I have the contractually right to deploy that, and the LP can't do anything about it. So I figured, there's a ton of dry powder out there. People are still going to keep deploying it. That'll be fine. What you come to learn is this is such a relationship game that people will rip that stuff up. And, if I'm running a venture fund or a private equity fund, I'd rather maintain a relationship so I can, lick my wounds today and come back and run another fund at some point in the future. So oftentimes you're just casually agreeing to not deploy that capital that they have committed because, we need to take a break for a minute because things didn't go well. And So you have that soft relationship aspect at play, which really, you might see some data or statistics around how much money is available to be deployed. That is not the true amount because of that relationship concept.
Yep. And I think again, that's something that a lot of people maybe aren't as aware of when it comes to like negotiating those deals is, they might even have a VC partner that says, "Hey, we have all this uncapped or untapped powder that we can burn." Yeah, when it comes to, rubber hits the road and you need something signed, they can't do the bridge because, investor maybe doesn't have the appetite for it, especially if they're maybe a smaller firm that only has a very limited investor portfolio.
And all it takes is you do one capital call, and the head of the Harvard Endowment Fund says, "Why are you deploying capital now? We can't be doing this anymore." And then you're not going to be making that call again after that. That's kind of how this stuff goes down.
Yep. So we definitely see how companies were able to maybe bridge that 2023 gap and why maybe it didn't unclog as much as we thought for 2023 for IPOs. But it seems like there's been a lot of good activity in the market in the first quarter of this year. So Craig, if you could give us a brief overview of what DFIN is seeing in the overview of Q1 and how you think that's going to shape Q2.
Yeah. So I think as 23 built into 24, the IPO market is better, but it's still not fully recovered. So it's picking up. A range of firms are attracting buyers, which feels great in comparison to what's been a super challenging 2 years. So far in 2024, 12 IPOs greater than 50 million have priced this year, raising 6 billion. We expect four more to go in just the next few weeks. So closing out the quarter, hopefully, with about 16 IPOs. So it's a significant increase from the proceeds from the past couple of years in Q1, but still a far stretch from 2021.
And are you seeing,
Go
sorry,
ahead.
Craig, I was just going to say, are you seeing anything with the, discussion of interest rates and the Fed supposed to be discussing this week and into next,
Yeah.
going to affect that pretty significantly?
Yeah, it certainly gives confidence. So a number of macroeconomic factors are pointing to that the Fed would move sort of mid-year to reduce rates. You had something last week. It was a little bit like cautionary about will they reduce, will they hold off? But I think the geopolitical situation and certainly the election year here in the United States will all play into it. The market doesn't like uncertainty, so the
Mhm.
certainty of a rate cut helps. The uncertainty of administrations causes some consternation. But
Mhm.
the market's been receptive. We have 5 companies already that have raised over $500 million, which is terrific. BB Foods, Bright Spring, the largest Amerisports.
Oh yeah.
So 16, not so bad. In 2022 and in 2023, in Q1, we had 6. So up from that, but still off from the 60 that we had in Q1 of 2021.
Mhm. So yeah, so definitely we're seeing some ease in the marketplace still going into this first quarter. We're hoping that's indicative of like a very strong second quarter and a good market, I guess, sentiment towards IPO and that valuation. So that's great to see. And Mike, I mean,
Or
you
just
talk to a lot of our customers. Can you add any color based off customer conversations?
So what we're seeing is a lot of our customers are starting to engage in the IPO readiness portion of it. So getting, just want to be ready when the window opens up. I do wonder, if you think about the timing today, now's a good time to get that going and be ready to go around post-election time. So maybe there's some thought around, hey, let's let the election shake out and then we'll go public when there's some more certainty in the market. But with that, Craig, I feel a little dumb for not knowing the answer to this, but you know, current election aside, the nuances of the current election aside, let's put that to the side. In an election year in general, are there a fewer number of IPOs because of that uncertainty, or is it not really that correlated?
it's not super correlated. You had in the recent past the election that happened during the financial crisis. So sort of completely unrelated to Obama and McCain running against one another. There were just massive macro issues that
Got
were
it.
that that kind of crushed the market. I mean, my personal perspective, just having been in the business a long time, the market is somewhat unmoved by either candidate usually. They just want to have some surety.
Mhm.
So they like to know who, and then they can adjust within that. Whether they're going to be regulatory friendly or not, friendly to some industry or not. That's really the only thing that sort of moves it. My perspective is that in a normal year, I think we're in sort of a normal election cycle. We'll likely see some strong companies go before the election, so probably all the way up to and including October.
Mhm.
So what we're hearing from our clients, they're ready. They're certainly optimistic. I think you're right. I think it sets up an even larger return to the IPO market in 2025. So I think then you're going to have a much more broad-based acceptance because you have a lot more known. You have a new president, you have inauguration on the 20th, like off you go
Mhm.
into 2025, which I think regardless of the outcome, the market will have certainty, surety, and it should continue to take off from there.
So when
Awesome.
you, I mean, so it sounds like from the perspective that you're having on our customers, Mike, is there's a lot of pipeline building for Craig and DFIN, right? There's a lot of work out
Yes.
there that is building because if we usually you see IPO readiness start well before you see more of the financial preparation aspects that needs to take place to really transact, right? So you need to shift your organization's mindset and all these different things, and that can take anywhere from, I mean, some companies takes 36 months. People try to do it in as little as 12. So it seems like the market's definitely clearing up, and we have plenty of pipeline that's kind of unofficially happening in the background. Are you hearing anything on kind of dual track for companies? Are they looking to say, hey, listen, we're ready for an IPO or for another round of financing, depending on which one comes first, or from switching from maybe a VC backed opportunity to a PE backed opportunity so we can grow a little bit more to get those $500 million valuations going public instead of, sub 50?
Yeah, I think optionality is key. So a lot of companies are going to be running the dual track process, be ready to be acquired or go public from there. So optionality will be big, particularly with the uncertainty around AI. So that's probably one of the biggest uncertainty factors in the market right now is how much AI is going to impact any given industry. And so, some investors might want to be lined up to sell to a big strategic if they feel as though AI might be like an existential threat to their business, right? That's the worst case scenario is want to drop the bag on somebody else before things fall apart. So with that, you just always want optionality as well. But that to me feels like a kind of an acute reason to want optionality is because of the potential for AI.
Yeah. And Craig, I mean, with Venue and Active Disclosure, you deal with tons of M&A and different rounds of financing as well. Are you seeing something similar when you're talking to your customer base?
Yes. You know, just this week we had a Downhole, which was a company that was nearing their listing date. So working with us was acquired by Innovex. So I think, Mike, to your point, getting ready and being prepared means a number of different things. And it can be an acquisition. So, versus you obviously have a lot of advisors and smart people who are working with you. And so as you run up to the IPO, it creates some potential excitement of somebody acquiring you, which is exactly what happened this week. So I think we'll continue to see that. You mentioned San Diego and the healthcare life sciences. Very robust pipeline right now. So whether that's 24, 25, or beyond, these companies need to be ready and start to be professional about how they're presenting their internal workings, right? Their close, how they're reporting out, how they're formally reporting to their board and to their investors, because the journey can take them in a number of different directions.
Craig, that's actually a great segue into what I wanted to actually ask you next, which like, can you give us just a quick 101 on the paths of, not necessarily IPO, but just transaction, right? Because we said, well, sometimes it's traditional IPO. I mean, we've talked about SPACs in the past. We obviously have M&A work, whether that's shifting from VC to PE. So if you can just give us a quick 101 on where companies can actually anticipate having some of these different styles of transactions, that'd be great.
Sure. We have a number of resources on our website, whether it's the guide to going public, whether it's readying for a SPAC versus an IPO. It breaks down the differences and the timing. and how to be prepared for all of those optionalities. And then certainly when you're prepared and when you have a diligence room, a virtual data room ready, it can take a number of different paths. You have competitors that knock, you have people that want to move into adjacent opportunities. So this journey to the IPO is certainly, I think, divided in pre, and in those pre-IPO initiatives, you're really setting up the groundwork for a transaction. So it's really pre-transaction, whether that's fundraising, additional investment, acquisition, IPO, or being a part of a de-SPAC. Being prepared means that you're going to be able to take the opportunity, whatever window is open to you and best for your company, and take it from there. Then you have sort of the post-IPO. So whether you've actually have gotten to the point of a de-SPAC or actually an independent listing, there's the whole process of how you report and how you're prepared post that transaction.
And I really like the
I,
way you phrase that, where you talk about instead of saying necessarily pre-IPO, maybe what we should really call is like pre-transaction, right? It's like semantics a little bit, but the idea is you're going through a transformation process that is meant to make your organizational agile enough to take it in whatever path is necessary for, the company to grow, whether that's a PE firm that gets really excited, wants to maybe buy you out before you go public because they see a good valuation that they can snag and it's guaranteed for the current investors so they can avoid, any kind of IPO kerfuffles that happen with, mispricing, whether you're low or high. And
Mm-hmm.
so it's really about more or less thinking about it like you have a transaction that's imminent because there's a desire from your current stakeholders to transact. And in theory, you have a good enough operation and kind of strategic vision that there's value there. So making sure that your financial organization and your organization in its entirety is more or less prepared for whatever that transition is.
I will say I think being IPO ready is the most extreme ready you'll ever be as an organization, and so you're just going to naturally be ready for M&A. And if you're I think to our CFO Razak, he was the VP of finance at Looker, and they were getting ready for an IPO, and then Google bought them out the day before they were going to go public. So Razak wants to avenge that at Flowcaster, which is great. We're going to make that happen. But if you're a strategic like Google, it makes perfect sense to take someone out pre-IPO, because once they go public, it becomes significantly harder. And then all of a sudden, that IPO date is a forcing function, where when you're looking at M&A, you can kick the tires, get to know each other for a while, see if it's going to shake out. The strategic can maybe try to build something that competes with you while they're trying to see if they should partner or purchase you. But as soon as there's an IPO date, you have an actual deadline to force the strategic acquirer to make something happen. I think that's the more common use case. Private equity, I don't think that's really in the mix as much pre-IPO, because that's a really good price has been set by the bankers, and the price is generally going to pop post-IPO for sure. But that's generally doesn't seem to be when they buy. It's like after there's the raiders at the gates after the price is dipped.
Yeah, that's actually what happened to us at Kodiak Cakes, though. Is we switched from VC to PE instead of going public, because there was a good
Oh,
alignment.
interesting. Okay.
And the PE firm was the right one to really grow the company more to actually drive a better, probably IPO value in the future. Could we have transacted? I think most likely. Obviously, I was the corporate controller, so not necessarily the expert, but from my perspective of the organization, I think it was there.
I'm in my tech bubble where there's generally a lot of cleanup opportunity to be had, and so it's viewed more on the cost cutting and cleaning it around. Not my understanding is you ran a nice shop over at Kodiak Cake, so it's about how do we grow more, which is not the general mentality within the tech private equity world. So that's a really interesting distinction there. Yeah.
Yeah, and I think that's the thing is, it can kind of depend on what industry you're in and everything like that. But they found a great partner with Catterton to come in and help them grow more. So all of this to say is I think that Greg's point of like, maybe it's a little bit of arguing the wording here, but it's being IPO ready does make you transactionally ready in any kind of sense. We had talked briefly about SPACs, Craig. I don't want to spend a lot of time on this, but I don't think it's quite dead out there. I think it's there's still a little bit life left in SPAC. So what are you seeing as far as de-SPACs for 2024?
Yeah. The SPAC market was greatly diminished from its peak. The SEC formalized, they codified the new SPAC rules this January, which clamps down on the lofty forecasts the companies were able to make. So these new rules remove the legal protections that were afforded to them And I think it begins just a new stricter era for blank check companies, which could be completely fine. Um, the SPAC initial IPO listing, so the actual creation of the blank check, peaked in 21 at 162. There were 21 and 22. There were four and 23, and we've had four so far this year in the first quarter. Um, there are currently 32 SPACs in the pipeline to list to create that blank check company, and so
Oh, interesting.
some of them could be at risk of withdrawing or being declared abandoned. So I wouldn't look for all of those to make it to the other side. But there's 105 SPACs that are searching for a target. So a
Hmm.
SPAC blank check company looking to put those funds to work. And there's 136 SPACs that have announced their acquisition targets. So not all will find a target, not all will complete, but it's still a pretty robust number that's out in the marketplace. And you have a number of high-profile deals that have completed in Q1 this year.
That's more than I expected. Yeah.
Yeah, I think that's really interesting to find out that we already have more that have kind of like listed or looking to in 2023 than 2022, which shows that the IPO market's also unclogging for SPAC, and that's still um, it's still a valid path to transaction, right? It's not completely removed. It can still be a way your company might have to transact. So there's still life left in that. It's just matured, and it might be a very bit more of a targeted way to going instead of the traditional, like, hey, this is a quick and easy way to go public. That allows us to get there without necessarily fully transacting. So
Yep.
yeah, that's super interesting.
I think that's a great thing for what it's worth.
Yeah, I mean, I think it's always good to have more options as far as organizations, as far as like how they can go and different optionality there. Um, when we look though at valuations for 2024, are you seeing any real trends that help drive that best valuation opportunity if we look at more of a traditional IPO path? Sorry, I'm going to throw that one to Craig. I don't want to set you up for failure on that one, Mike.
Yeah, Mike may know. I think Mike touched on it earlier, which is companies are coming to a realization of what their valuation is. So whether that's been in a down round, that's been part of the hangover from 21, that's in 22, 23, it'll continue in 24 and 25. I think companies have a much more realistic expectation of valuation and what it'll take, and therefore they'll start to tap the market again. Mike, how would you add
Yeah.
to it?
Yeah, I agree. I mean, there's a saying in VC right now that flat is the new up in this world. If you're raising flat or up from 2021, you're doing something right as a business for sure. I mean, that was clearly peak valuation was that second half of 2021. And a lot of companies have grown into it, have made the right moves and have grown into that valuation and could, if they wanted to take on some more capital to do some more interesting things, they could do that. But I'll tell you, a lot of them have not. I think one of the negatives of raising so much money is a lot of companies were slower to react to the downturn. One of the things I'm really proud of at Flowcast is how quickly we adjusted and we were able to do it without having to do a round of layoffs. So I think we played it all really well, and we're one of the fortunate ones that have grown into that valuation. I'm feeling good about that. But as I talked to my network and others, it was really an exercise of cleaning up expenses, putting out a forecast for getting to cash flow positive. All of a sudden, people cared about that. And when we're planning, we're hopefully not that far away. And so we need to start thinking about what do the markets care about? What do they not care about? And for example, we were doing our executive bonus plan for this year. And it was like, hey, how much do we want to weight it on growth versus a reduction in cash burn? And what should that look like? We ultimately landed at actually keeping it the same as last year, which was a bit more conservative on the cash burn side. So I think that just kind of explains the sentiment of where investors are at. They'd still value cash burn over growth. And then they'll say, but you got to grow fast as well. So they want it all, but maybe weighted more in the like 65% caring about burn versus 35% about growth. However, that changes over time, right? And so I wouldn't be surprised if by the time we'd be looking to go public, hopefully in a couple of years here, that very much flips and it's all about growth, growth, growth again. So when you're running a company and planning financially, it's tough to not fall for what matters the most today and think about what investments do we need to make for what is going to matter when we go public. And as in running Flowcast, that to me is really the fine line to walk is how do we invest to make sure, because my take is when we go public, growth will be valued. However, today it is not valued as much. So how do we, invest for that future, but not break the bank today?
Good
And
advice.
Tough trade-off.
it is. And I think, like what I hear from that is you need to have plans. You need to have not just one plan, but multiple like kind of paths that you can go. So if something plays out differently in the marketplace, you're able to act quickly as an organization to shift into that new kind of like whatever that lane is. So if
Yeah, and
things look
just
like
to
they could be opening up, then you need to have a growth plan in front of you that you can shift to. And if things look like they might tighten up, you need to have that cash burn plan that you can lean into as an organization. That's what it seems like people really want to see. Um,
Yeah, and just to clarify the cohort of companies I'm referring to, it's really the Series C, Series D, later stage companies in the back half of 21. We fit the bill, right? That was a Series D that we did, and that's a cohort of companies that would have been public by now had the market not gone down, right? That was in 21. We were talking about 24 as an estimated target for going public, but all things change when the market takes as big of a downturn as they did. So just my commentary is mostly around our world with the later stage investments from 21, of which there are a lot, of which there are hundreds and hundreds who raised over $100 million as a Series C or Series D company in 21.
yeah. And so when we're looking at that timing, Craig, I'll kick this one back to you. If people are looking to strike at that 2024 market opportunity and they're looking at where should they kind of be at in their pre-IPO readiness and financial readiness, where would you say they should be if they want to transact within, we'll say the last half of 24 or we'll say like the last, probably people want to transact before the election. So like, that September, October timeframe.
Yeah, now certainly now's the time. You got to solidify your internal narrative. So you got to bring on your right advisors. You have to develop your financial reporting systems and make sure that they're solid, picking great companies like Flowcast. You've got to have a way to report formally. You have to have a virtual data room set up to provide information and share that confidentially with advisors. You have to set up your SOX reporting. So all of that, just from a preparation perspective, now's certainly the time. Whether that's governance and legal, finance, accounting, taxes, your management and HR, you got to have a communications, strategy of how you start to talk about this. Certainly ESG can be a question that will be asked. So all these processes need to be in place before you get to really the point of the document, the drafting, the filing. That starts sort of 3 to 5 months out, and then certainly you move into the IPO from there.
And so, like, if someone's looking at today, they should have a lot of that organizational preparedness done so they
Yes.
can start heavily into that document drafting, whether that's an S1 or whatever document, whatever transaction path they're choosing going forward. Because that's when you have to put like all your, that's when all your financial data has to go into it. You have to have your valuation story. You have to have your pricing figured out. You have to have your brand image figured out and all that stuff. And that can be really hard to kind of get into one document. So, Craig, this is where I'm a huge fan of Venue and active disclosures. It allows you to get all that data in one place and then report on it cleanly in a nice reporting system. But that S1 is a significant lift. It's not a 1 month process. It's not a 2 month process. It is a long, 5 to 6 month process. And the better you have that, the better prepared you are for your roadshow, the better you are prepared for pricing questions, and the more likely you're going to transact. So if you're looking to transact in that time frame, be done with your organizational preparedness, be moving heavily into your document drafting stage.
And so something I'm learning about as we in real time here is that the S1 prep actually starts with other organizations much earlier than that. This is something I hadn't really processed. So if you I thought it'd be interesting to take a step back. We like to give career advice and help people move up on this podcast. That's part of it. So sort of the perspective of what's going on in CEO and CFO land, before you're going into the S1, you really should think of the S1. It's a pitch deck, right? It's an investor presentation. You're trying to get people excited, get the price as high as possible. And a big part of that is marketing. And so you have what's called a strategic narrative exercise that you do well in advance of preparing the S1. So you want to arrive at, hey, how do we want to frame the company? How do we want to position it for the street so that we get the best valuation possible and tell the best story? And sometimes that involves making product decisions to maybe detach yourself from a competitor or try to associate yourself with another business. How do we name this thing so it sounds maybe bigger or is more on point with what we need? And all of a sudden you have a lot of different people to where the branding and marketing matters. It's not just customers anymore. It's customers and investors as well. So they become equally important for how you market your business. And so, as you kind of see the CEO and CFO running around ahead of all this, just realize there's a lot of actual non-finance stuff that has to happen in the background, turning over the board. Oftentimes a board of directors is going to be a lot of your investors, your venture capitalists, but in the year or two leading up to the IPO, you need to get board ready and have all the right people added. Craig, you mentioned that, but that's a big thing that takes, years of work to get that going. So yeah, the S1, and we're all, as accountants, we know our world and what needs to get done here, but just thought it'd be interesting to know there's a whole lot that's going on behind the scenes ahead of that where other departments are involved in that whole process.
Yeah, I
Yeah.
think that's some great perspective. And I think, it helps people understand, it's like a lot of our educational work that I've like, we work here at Flowcast provide you is like we just did a wonderful webinar with DFIN on the whole traditional IPO S1 process and understanding the intricacies of that. But that is just one aspect of that going public. You need to have a lot of things set up as an organization beforehand as well. We only probably have time for one more question, so I'm going to throw it here at Craig because he has experience in this realm. So, Craig, what advice do you have for Mike to how to keep your company running in that post-public life?
Oh, great question.
Um, you have to have a great disclosure tool. So you have to have a tool like Active Disclosure that's going to allow you to work on your board reports, your formal reporting, not just your filings. So you've certainly got your AKs, your 10Ks, your 10Qs, your proxies. You have to lean on a provider like DFIN to provide ESG counsel to guide you through the early days of being public. We have many regulatory experts that are here at the ready to help you, whether that's getting your Form 3s on file, your NEO stock holdings, to the deadlines that you have for reporting, for doing a secondary, the reliability that you have from our regulatory team into a software tool that allows you to take control and make it easier for you to do the work you do, as well as your accountants and your lawyers, is really the ideal place that you want to be, especially that being a public company is going to take a lot of your time. And you want to be focused on where you can add the most value and leave it to us to help you be compliant.
Makes perfect sense.
Yeah, and what I love about that is it focuses on find the right partner for yourself. Technology is more than just what check the box functionality it does for you, but it's actually selecting a tech partner that works with you beyond just the way you might traditionally view the technology. So you can rely on DFIN to help you throughout the entirety of your transaction and then the post-public life cycle as well, and have that advice to give you, not just in the tool itself, but then in any kind of actual work there. And that's something we believe at Flowcast as well. We want to be that tool that helps you beyond just the tool itself. We have a whole team of customer care to kind of back that up. So probably why we have a great partnership, and probably why I can't recommend DFIN and Flowcast enough as an individual that's used Flowcast and seen a lot of success with our customers on DFIN.
That's a really, really good point. And the IPO, you'd think, oh, Flowcast is well suited to go public. And I'd like to say we are well suited to go public, but I also know enough to know we don't know everything. And we need someone who provides expertise, really knows what they're doing, has done this many times before, and provides great customer service to kind of hold our hand through that. Because like I said, I know enough to know I don't know enough to do this without help from other people. So yeah, really looking forward to working with you, Craig, as we go through this process. I can't wait till that day happens.
Expect some late night text messages from Mike saying, "Hey man, what are your thoughts on this?"
Yep. My understanding is very late night. Yeah, it's a lot of work. The hardest a CEO works in a company history.
We ready.
Awesome. Well, thank you everybody for attending this episode of Blood, Sweat, and Balance Sheets. We loved having you here. Please give us any feedback on this. Reach out to us if you want to engage in any of the content we're talking about. Craig mentioned earlier some of the materials that the DFIN offers in there. I've read many of these and used them myself. So please do not hesitate to download some of this content. It'll really help you. Check into our ebook that is or white paper that is coming out of this program as well. And check out our webinar if you haven't seen it. We're here to help you in the entirety of this process, not just from a technology point of view, but really understanding how to execute on your IPO. So with that, Mike, any closing remarks? Craig, any closing remarks?
I'll wrap it up with having gone through an IPO as a senior accountant. Very different perspective than when we're hopefully doing it as a CEO. But even in my senior accountant role, it was an incredibly challenging but rewarding experience. It's one of the best things to go through. It's not going to be easy, but you're going to learn a ton and be very well suited with your career and resume after you go through it. So just put your head down, grind, get through it, and you're going to really look back on it with fond memories. I very much look back on that process at Cornerstone with fond memories, and legitimately would not be here today had I not experienced a little bit of the pain at Cornerstone.
And rely on your advisors. Pick your advisors, pick a team that can help you. And Mike, we look forward to helping you on your next IPO.
Can't wait.
Awesome. Thanks, everybody.
All right. Thanks, everybody.